Doesn't get any bigger than this. Not only is earnings season upon us, but we've got tons of economic news ahead. Tesla and Netflix report earnings this Wednesday, and it's all about margins. Coupled with trillions of dollars of monthly options expiring on Friday, one thing is guaranteed: volatility. Let's talk about Max Payne. Can Tesla and Netflix beat earnings estimates, or will higher interest rates and a weakened consumer eat into margins? Let's talk about it. Welcome everybody to the special weekend edition where we are going to talk about the big catalyst news events for this week. If you like this content, please subscribe, hit the notification bell, like this video, and let's get into it. We have a pretty big week with earnings. So we have the two big ones on Wednesday, Netflix and Tesla, but there are a couple of big ones as well, big companies. ASML, a huge semiconductor company, American Express, as well as a couple of other ones such as Charles Schwab right here, Interactive Brokers, Bank of America, Lockheed Martin, Morgan Stanley on Wednesday as well, and heaps of other really big companies that do affect the market like TSM, Union Pacific. This is the implied move for the earnings, and I want you guys to have a look at Netflix right here, a plus or minus 8% move. Tesla right here, plus or minus 7%, and all of this is going to come down to margins. We really want to see how debt interest rates are going to affect these companies, and it's really good to keep an eye on this because this means volatility is going to come back into the market, especially in individual names. Let's talk about earnings, and we're going to look at Netflix. Here's some of the key takeaways for Netflix earnings. So the first big test for Netflix new strategy. So long story short, Netflix had about 100 million people that were using it for free by sharing passwords. They've had a massive crackdown on this, encouraging people to get a new account with them. Netflix has said that revenue growth should accelerate in the second half of 2023, and analysts think subscriber additions will also speed up as they implement this crackdown on password sharing. But there are some risks. Password crackdown could be a lot slower than hoped because it's not a process that just happens overnight. It's going to take quite a while to get 100 million people onboarded onto your platform, as well as advertising will be a slow burner, but it has the potential to provide a new catalyst in 2024. The thing is, you also have to onboard those advertisers, so it does take a while. So Netflix does trade at a premium to its rivals as the largest and most profitable streaming stock, but at a discount to wider technology. So here are the earnings consensus estimates. We're looking at a 7.7% year-on-year rise in revenue to 8.5 billion, which is in line with guidance, and its operating margin, its primary profitability metric, is expected to hold largely steady from the previous quarter at 22% and an operating profit of 19.8%. And we can see here that the earnings per share at the bottom line is forecast at 12.8% growth at $3.50 per share, thanks to top line growth combined with improved profitability. They can hit this, expect Netflix to see some upbeat action, but if they don't, we'll see what the stock does. Subscriber growth. This is a big one because Netflix's main form of revenue is subscribers. They do now have advertising, but the more subscribers they have, the more money they make from advertising. And we can see here that advertising subscriber growth did stall sort of around this area right here until they implemented the password sharing crackdown, and we have seen an acceleration of growth in subscribers. We are looking at about $250 million for 2023 Q4 interim. 250 million subscribers. If we could get just above that or beat, that's very bullish for Netflix. Moving on to Tesla. So the key takeaways for Tesla right here in Q3 is going to be earnings per share of 0.74 as well as revenue of 24.21 billion. We want to see what Elon Musk says about price cuts. Tesla has seen about a 25% year-on-year drop in prices to combat higher interest rates. So we're going to see what he says about that, as well as forward guidance. Now let's look at production and deliveries right here. So Tesla routinely announces production and delivery performance a few days after the quarter closes. And we did get those numbers last week, I believe, or the week before last. And we got production totaled 430,000 units and deliveries were 435,000 units. The delivery total marked a 6.7 decline from the prior quarter when the EV handed over 466,000 units. The delivery slowdown was partly related to production. Elon Musk had previously warned about the production would dip due to factory shutdowns and planned upgrades. The average analyst expected Tesla to deliver that amount, so 455,000. So it was about a 20,000 vehicle drop. But like you said, Elon Musk had already warned about that. And he also, and like I said before, vehicle prices had roughly lowered 25% year over year, and the company is still anticipating next year 1.8 million vehicles for the year. And they reiterated that guidance this week, so it seems like 1.8 million is what we want to hit and then get to that 2 million mark in 2025. Now, revenue and earnings estimates right here. So we spoke about this previously. 73 cents per share is what we're looking for. That's the target. And $24.38 billion with revenue up 14% year over year. So you can see right here, we are expecting this right here, and we can see that into Q4 2023, we are expecting this to increase. So it's very key that we do hit the 0.75 target, because by hitting this or better, we're actually gonna accelerate to above $1, just under $1 in 2024, and then $1.10, $1.12 looking to 2024. Let's move on to economic data. So we have quite a lot of stuff in the calendar this week. We have NY State Manufacturing Index. We also have quite a number of Fed committee members speaking. We got Fed Harker, Fed Williams. So we have retail sales right here. Looking at Thursday and Friday, we do have quite a bit of stuff here as well. We have the beige book, which is pretty important, and we also have Fed Cook speech right here, and then we have initial jobless claims. I know we see these numbers every single week, but it is important because initial jobless claims are a leading indicator to what a recession might look like. Right now we're sitting at about the 200,000 mark, but once we get to the 400k, that's when things get bad, because that leads to just a general economic slowdown. And then on Friday, there's nothing major on Friday. We do have existing home sales, but the big one on Friday, I believe, or Thursday, it'd be Friday my time. So Jerome Powell is speaking, and this is the committee member you want to hear from. He's the big guy, he's the Fed chair. He's going to be speaking on Thursday. Now, Max Pain, Friday is options expiry, and Max Pain right now is at 430. So the SPY right now is trading at 431. So right here, and that's the current price as well. We can see huge amounts of open interest around the 399 to 420 area right here for puts, and then for calls, it's more around the 422 to 449 area. There's a ton of open interest right there. Max Pain as of right now is 430, so we can expect the price to be around there. That's where most options contracts will expire worthless. That's where Max Pain is. But thank you so much for watching this, guys, this special weekend edition. If you want more, please like, comment, subscribe. Tell me what you guys want to see, and I'll get into it. Toodle pip.